At 9 a.m. on December 11, 2008, the FBI arrived at a penthouse on the Upper East Side of Manhattan. The man who opened the door was wearing a bathrobe. He was 70 years old, calm, and utterly ruined. Just 24 hours earlier, this man, Bernie Madoff, had sat his two sons down in his office and told them that the $19 billion in his investment fund didn't exist. It wasn't that the market had turned against him. It wasn't bad luck. It was that the money had never been invested at all. It was, in his words, just one big lie. A giant Ponzi scheme. When the news broke, the headline number was $64 billion. It was a number so large it broke the scale of financial comprehension. It wiped out charities, destroyed aristocratic European fortunes, and humiliated the biggest banks in the world. But here is the thing that nobody talks about. For 20 years, Bernie Madoff told the world exactly how he was making money. He printed it on statements. He explained it to regulators. He called it the split strike conversion. It was a specific mathematical strategy involving options, hedges, and blue-chip stocks. And for 20 years, the smartest people on Wall Street looked at his math, nodded their heads, and handed him their cash. They didn't know that the strategy was physically impossible to execute at that scale. They didn't know that the trades were being printed on a dot matrix printer from the 1980s to make them look authentic. Today, we aren't just telling you Madoff stole the money. We are going to open the hood and show you exactly how the engine of the largest financial lie in history was built. To understand the lie, you first have to respect the truth that hid it. If a stranger on the street offers you 20% returns, you call the police. If the former chairman of the Nasdaq offers you 12% returns, you say thank you. Bernie Madoff wasn't a nobody. Before the fraud took over, he was a genuine revolutionary. In the 1960s and 70s, stock trading was a clubby, inefficient mess, where guys on floor exchanges shouted prices at each other and took massive commissions. Madoff was one of the first to realize that computers could do it faster and cheaper. He built a legitimate wholesale market-making firm. This is important. Madoff Securities, the broker-dealer arm, was real. It was a powerhouse. By the late 1980s, his firm was processing up to 5% of the entire trading volume of the New York Stock Exchange. He was wealthy, he was respected, and he was consulted by the SEC on how to modernize markets. This legitimacy was the shield. When people looked at Bernie, they didn't see a hustler. They saw a titan of industry. They saw a man who had already made hundreds of millions of dollars legally. So when he started his private investment advisory business, a secretive side operation located on a different floor of the Lipstick Building, nobody asked for references. Why would they? He was Bernie Madoff. But while the 19th floor was trading stocks at the speed of light, the 17th floor was locked down, running a secret operation that hadn't made a real trade in decades. Usually, frauds are loud. Ponzi schemes like Charles Ponzi or crypto scammers today spend millions on marketing. They beg you to join. Madoff did the opposite. He weaponized rejection. If you wanted to invest with Bernie, you couldn't just write a check. You had to know someone. You had to be a member of the right country club in Palm Beach or Long Island. And even then, Bernie might say no. He would tell potential investors that the fund was closed, or that he didn't like their attitude. This created a frantic desire to be let in. It turned a financial transaction into a status symbol. Before we explain the mechanics, I want you to understand this mental trap. By making it hard to enter, Madoff bypassed the due diligence part of the brain. When you finally got the call saying Bernie would take your money, you didn't ask to see the audit trail. You felt relieved. You felt special. This is the velvet rope effect. Madoff knew that if he acted like the money didn't matter to him, you would throw it at him. And you should listen closely to this part, because the next time you see an investment opportunity that frames itself as an exclusive club for the chosen few, you need to remember that exclusivity is the oldest trick in the con artist's handbook to prevent you from asking how the sausage is actually made. Most people view finance as a black box. They trust the smart money because the jargon is designed to keep them out. Madoff relied on that ignorance. He relied on the fact that his clients didn't understand what a split-strike conversion actually was. They just liked the graph that went up. At Capital Curriculum, we dismantle the black box. We tear apart the balance sheets, the legal loopholes, and the mechanisms of power so that you can't be lied to. If you want to be part of the minority that actually understands how capital moves in the dark, make sure you are subscribed. We don't do surface-level summaries here. We do forensic analysis. Now, let's look at the specific lie Madoff told, and why, mathematically, it was a masterpiece of fiction. So, what exactly did Madoff claim he was doing? If you asked him, he'd lean back and say, split-strike conversion. It sounds complicated, but it's actually a fairly standard strategy known as a collar. Let's break it down simply. Imagine you buy a basket of stocks, say the top 35 companies in the S&P 100, IBM, Coca-Cola, Exxon. If the market goes up, you make money. If it crashes, you lose money. That's normal investing. But Madoff claimed he was hedging his bets. First, he would buy put options. Think of a put option as an insurance policy. You pay a premium, and if the market crashes below a certain price, the option pays you back. This sets a floor on your losses. You can't lose everything. But insurance is expensive. Buying puts eats into your profits. So, step 2. Madoff claimed he was selling call options. A call option gives someone else the right to buy your stock if it shoots up to a high price. By selling this right, you collect cash, a premium. This cash pays for your insurance. The trade-off? If the market skyrockets, you don't get all the profit. You are capped. So, the result of a split-strike conversion should be boring. You chop off the big losses, but you also chop off the big gains. You should get a steady, moderate return with low volatility. That is the theory. It is a legitimate strategy used by pension funds every day. But Madoff wasn't presenting a legitimate strategy. He was presenting a statistical miracle that defied the laws of gravity. Here is where the lie began. A real split-strike strategy moves with the market. If the S&P 500 drops 20%, a good collar might restrict your loss to 5%. But you still lose. If the market rips up 20%, you might make 8%. You still see volatility. Madoff's returns didn't do that. His returns were a straight line pointing up at a 45-degree angle. Month after month, year after year, he reported gains of roughly 1%. Up 0.8% in January. Up 1.2% in February. When the internet bubble burst in 2000 and the Nasdaq lost 78% of its value, Madoff was up. When the market crashed after 9/11, Madoff was up. In finance, this is called a Sharpe ratio anomaly. The Sharpe ratio measures how much return you get for the risk you take. A ratio of 1.0 is good. A ratio of 2.0 is legendary. Madoff's Sharpe ratio was somewhere around 15. This is the equivalent of a baseball player hitting a home run in every single at-bat for 20 years. It isn't just unlikely, it is statistically impossible. Markets are noisy. Hedges aren't perfect. Timing is never flawless. But Madoff's investors didn't care about the Sharpe ratio. They saw a bond-like safety with equity-like returns. It was the Holy Grail. And because Madoff claimed he was timing the market, entering and exiting the basket of stocks intermittently, he gave himself the perfect excuse for why his returns didn't match the index. He was simply smarter than the market. Or so he said. You might wonder, why didn't the professionals spot this? The answer is, they were paid not to. Madoff raised billions through feeder funds. These were hedge funds like Fairfield Greenwich, run by Walter Noel, or Tremont Group. Their entire business model was simple. They raised money from wealthy Europeans or South Americans, handed it to Bernie, and charged a massive management fee for doing absolutely nothing. Fairfield Greenwich, for example, took over $500 million in fees over the years just for funneling cash to Madoff. They had a fiduciary duty to check if the trades were real. But if they checked and found a problem, the fee stream would stop. So they engaged in performative due diligence. They would fly to New York, have lunch with Bernie, look at his impressive office, and fly home. They ignored the red flags because the red flags were made of gold. Madoff even allowed these funds to leverage up, borrowing money to invest more with him, magnifying their returns. It was an ecosystem of parasites, feeding off a host that they suspected was dirty, but was too profitable to question. This wasn't just Madoff's crime, it was an industry-wide conspiracy of willful blindness. The consequence of this silence was that the scheme grew to a size that threatened the stability of the global financial system. By 2008, Madoff was managing more money than General Motors. He was effectively operating a shadow bank. Major European banks like HSBC and Santander had exposure to him through these feeder funds. They were treating Madoff's accounts as cash equivalents, money that was safe and liquid. But there was a problem. In a real investment fund, your money buys stocks. You own a slice of IBM or Apple. Even if the manager dies, the stocks are there. In Madoff's case, the money wasn't buying stocks, it was buying belief. And as we are about to see, when you peeled back the layers of the split strike strategy, there were no options contracts. There were no baskets of stocks. There was just a checking account at JP Morgan Chase, account number 703, sitting there, waiting to run dry. Let's go inside the Lipstick Building. 3rd Avenue, Midtown Manhattan. If you got off the elevator on the 19th floor, you saw the legitimate business. Bright lights, mahogany desks, traders shouting, millions of dollars of real technology. It was impressive. But the fraud didn't happen there. It happened 2 floors down, on the 17th floor. Access to the 17th floor was restricted. The windows were covered with blinds. The technology was ancient. While the rest of Wall Street was moving to digital clearing and high-frequency trading, the 17th floor was running on an IBM AS400 server, a relic from the 1980s. This is where Frank DePascali, Madoff's right-hand man, reigned supreme. DePascali wasn't a polished financier. He was a guy from Queens who barely finished high school, but he knew how to program that old IBM computer to sing whatever song Bernie wanted. The staff on the 17th floor were not traders. They were secretaries and data entry clerks. Their job wasn't to analyse markets. It was to look at yesterday's newspaper, see where the S&P 100 had closed, and then retroactively buy the stocks at the day's lowest price and sell them at the highest price. They were betting on horse races that had already been run. This is why Madoff's returns were so perfect. He wasn't predicting the future. He was backdating the past. And to make it look real to the clients, they printed millions of pages of trade confirmations on dot matrix paper, folding them and stuffing them into envelopes by hand, because the noise of the printers and the physical paper made the older investors feel secure. The heart of a Ponzi scheme is cash flow. You need new money to pay off the old money. Madoff didn't use a complex web of offshore shell companies to hide the cash initially. He used a single checking account at JP Morgan Chase in New York. Account number 703. For years, billions of dollars flowed into this account from investors, and billions flowed out to pay redemptions. At any given moment, there might be $3, $4, or $5 billion sitting in that account. But according to the client statements Madoff was sending out, he was supposed to have tens of billions in assets. The discrepancy was the fraud. He wasn't buying the split strike basket. He wasn't buying the options. He was just parking the cash in a low-interest checking account. This account was the single point of failure. JP Morgan's own computers flagged the account repeatedly. The transaction behaviour was bizarre. Massive round-trip wires to London, huge daily inflows consistent with money laundering or fraud. But the bank was making massive fees on the account activity. They filed suspicious activity reports, SARs, with British authorities, but failed to communicate those concerns effectively to US regulators. Madoff used this single pool of cash to pay anyone who wanted to leave. As long as the amount of money demanded by leaving clients was less than the cash sitting in account 703, the illusion held. It was a bathtub with the drain open, but the faucet was running full blast until the water pressure stopped. How do you fool an auditor? Madoff had a problem. If he claimed to hold $10 billion in General Electric stock, an auditor could simply call the Depository Trust Company, DTC, the central clearinghouse for US stocks, and ask, "Does Bernie Madoff own this stock?" The answer would be no. So Madoff couldn't let auditors call the DTC. He needed auditors who wouldn't ask. He found Freeling and Horowitz. It sounds like a law firm or a mid-sized accounting practice. In reality, it was a guy named David Freeling operating out of a strip mall in Rockland County, New York. Freeling was the auditor for a multi-billion-dollar global hedge fund. He didn't have a team of forensic accountants. He was barely doing the books. Madoff basically told him what the numbers were, and Freeling signed off. But for the more sophisticated clients who demanded proof of custody, Madoff created fake DTC screens. DePascali wrote software that mimicked the interface of the DTC clearing system. When a client came in for a rare inspection, they would show them this fake screen on a computer monitor. Look, there are your shares. It was a video game, a simulation. But because it was on a glowing green screen in a midtown office, people believed it. They trusted the screen more than they trusted common sense. But technology wasn't the real mechanism. The real mechanism was affinity. Madoff targeted the Jewish community. He targeted country clubs. He targeted charities. He understood that if you rip off a stranger, they sue you. But if you rip off your friend, or your friend's friend, they hesitate. They feel awkward asking for proof. They assume you wouldn't do that to them. This is called affinity fraud. By embedding himself into the philanthropic boards of New York and Palm Beach, Madoff made his fraud a matter of social cohesion. To question Bernie was to insult the community. This social pressure acted as a firewall against investigation. But while the social circles were polite, the mathematics of the market are ruthless. And in Boston, there was a man who didn't care about social circles, didn't care about Madoff's reputation, and certainly didn't care about being polite. He just cared about the numbers. And the numbers were screaming that Madoff was a liar. Enter Harry Markopoulos. He wasn't an FBI agent. He was a quantitative analyst at a rival firm, Rampart Investment Management. In 1999, his boss dropped Madoff's marketing brochure on his desk and said, "Bernie Madoff is doing this split strike strategy and making 12% a year with no volatility. Figure out how he's doing it so we can copy it." Markopoulos looked at the numbers. He looked at the strategy. It took him 5 minutes to realise something was wrong. It took him 4 hours to prove it mathematically. He realised that to execute the strategy Madoff claimed, buying protective puts and selling calls on the S&P 100 index, you need to buy options. Options trade on public exchanges like the CBOE. Volume is public. Markopoulos calculated the size of Madoff's fund and realised that for Madoff to be hedging the way he claimed, he would need to own more options than actually existed in the entire world. Madoff would have to be 100% of the market, and even then, it wouldn't be enough. Markopoulos famously said, "The market isn't that deep." It was a physical impossibility, like claiming you fit an elephant into a suitcase. You don't need to open the suitcase to know it's a lie. You just need to measure the elephant. Markopoulos didn't just shrug and move on. He became obsessed. He realised this wasn't just a competitor exaggerating, it was a massive crime in progress. In May 2000, he sent an 8-page submission to the SEC's Boston office. He laid it out. The world's largest hedge fund is a fraud. He offered 2 scenarios. Scenario A. Madoff was front-running his broker-dealer clients. Illegal, but common. Scenario B. It was a Ponzi scheme. He laid out the math. He showed the impossibility of the options volume. He showed the statistical anomalies of the returns. And the SEC did nothing. They didn't understand the math. The investigators were lawyers, not quants. They looked at Madoff, a legend, a former NASDAQ chairman, and then they looked at Markopoulos, a nobody from a rival firm in Boston. They assumed Markopoulos was just jealous. Over the next 8 years, Markopoulos sent submission after submission. In 2005, he sent a detailed 21-page document titled, "The World's Largest Hedge Fund is a Fraud." He listed 29 distinct red flags. He practically drew a map to the bodies. The SEC actually opened an investigation this time. They interviewed Madoff. Madoff gave them a long, rambling, technical explanation, dropped names of powerful friends, and told them he used a proprietary model. The SEC investigators, intimidated and out of their depth, closed the case. They never performed the one simple check that would have ended it instantly, calling the counterparties to verify the trades. This is the most terrifying part of the Madoff story. It wasn't a master heist executed in the shadows. It was happening in broad daylight, with the regulators staring right at it. The SEC failed because of regulatory capture and incompetence. They feared disrupting a powerful market figure more than they feared protecting investors. Madoff knew this. He later said in prison that he was astonished they didn't catch him. He said, "I would have surrendered if they asked for the trade tickets." He was waiting to get caught. Every time the SEC walked in, he thought, "This is it." And every time they walked out, satisfied with his lies, his ego grew. He began to believe he was untouchable. He began to believe that the rules of economics actually didn't apply to him. But while you can fool the SEC, and you can fool the investors, you cannot fool the liquidity cycle. You can only pay people with other people's money for so long. Eventually, you run out of other people. By 2005 and 2006, the scheme was under strain. Hedge funds were booming, and investors were looking for higher returns than the steady 10% Madoff offered. Money started to trickle out. To keep the scheme alive, Madoff had to expand. He started taking money from more dubious sources. He tapped into European aristocratic money through feeder funds that didn't ask questions. He started accepting money from offshore vehicles. The frantic search for cash behind the scenes was a stark contrast to the calm demeanour he projected in public. Di Pasquale was juggling the books daily, moving money between accounts to cover checks. They were robbing Peter to pay Paul, but Peter was getting broke. And then came 2008, the year the music stopped for the entire world. September 2008. Lehman Brothers collapses. The global financial system goes into cardiac arrest. Stock markets plunge 40%. Investors are panicked. They don't care about returns anymore. They care about survival. They want cash. Everyone starts calling their money managers to redeem their funds. For a legitimate fund, this is painful. They have to sell stocks at a loss to pay the clients. For Madoff, it was a death sentence. He didn't have stocks to sell. He only had the cash in the JP Morgan 703 account. In the final weeks of 2008, Madoff received redemption requests totaling $7 billion. But the account only held a fraction of that. Madoff scrambled. He tried to raise money from his oldest friends. He pressured the feeder funds to find new victims. He even reportedly reached out to cartel-adjacent money. But the liquidity had dried up globally. Nobody was investing. Everyone was withdrawing. The classic Ponzi mechanic, using new money to pay old, was broken because there was no new money. In early December, Madoff told one of his investors that he needed to raise $1 billion immediately for a special trade. It was a desperate lie. The walls of the lipstick building were closing in. On December 10, 2008, with the end inevitable, Madoff made a strange move. He proposed paying out roughly $170 million in bonuses to his staff and family 2 months early. He had about $200 to $300 million left in the bank. He wanted to distribute the remaining crumbs to his inner circle before the explosion. This decision is what triggered the end. His sons, Mark and Andrew Madoff, who worked in the legitimate trading arm of the business, the 19th floor, confronted him. They asked, "How can we pay bonuses if we can't pay clients?" They knew the firm was struggling, but they thought it was just market stress. Madoff couldn't explain it. He told them to meet him at his apartment. That is when the split reality collapsed. He sat them down and confessed. He told them everything. The split strike strategy, the billions in assets, the steady returns, it was all a big lie. The sons, realizing they were potentially accomplices to the greatest financial crime in history, went straight to a lawyer, and then to the FBI. They turned their father in. The next morning, the FBI knocked on the door. When the news broke, the devastation was total. It wasn't just billionaires losing a yacht. It was Jewish charities like Hadassah and Yeshiva University losing huge portions of their endowments. It was retirees in Florida who had put their entire life savings with Bernie because they trusted him like family. People lost their homes. Some lost their lives. At least 2 investors committed suicide in the immediate aftermath. The tragedy extended to Madoff's own family. His son Mark, unable to bear the shame and the endless lawsuits, hanged himself 2 years later on the anniversary of his father's arrest. The total paper loss was $64 billion. The actual cash loss, money people put in and never got back, was closer to $17 to $20 billion. It wiped out the concept of trust for a generation of investors. It revealed that the SEC was a paper tiger. And it showed that if you tell a lie big enough, and you tell it with enough confidence, even the most sophisticated people in the world will believe you. But the story didn't end with the arrest. Then came the clawback. A court-appointed trustee, Irving Picard, was tasked with recovering the stolen money. And he did something controversial but brilliant. He looked at the investors who had taken money out of the scheme before it collapsed. These people thought they were safe. They thought they had made a profit. Picard argued that those profits were fictitious. The money they took out wasn't profit. It was stolen money from other victims. He sued them to get it back. It was a legal war. Innocent investors who had spent their profits years ago were forced to sell their homes to pay back into the victims' fund. It was brutal, but it worked. Picard has recovered over $14 billion of the lost principal, an unprecedented success rate for a Ponzi recovery. It proves that in a Ponzi scheme, there are no innocent winners. If you made money, you were unknowingly an accomplice receiving stolen goods. The toxicity of the fraud infects everyone who touches it, even decades later. The Madoff scandal rewrote the rulebook. It forced the SEC to finally start verifying assets with third-party custodians. It killed the black box hedge fund model for a while. But have we actually fixed the problem? The core mechanism Madoff used, opacity and the appeal to authority, is still very much alive. Look at FTX. Look at the crypto yield scandals. The assets changed from split-strike conversion to proprietary trading algorithms, or yield farming tokens. But the structure is identical. A charismatic leader, a complex explanation that nobody questions because they don't want to look stupid, and a complete lack of independent verification. The Madoff scandal wasn't an anomaly. It was a stress test of human psychology, and we failed. We failed because we wanted to believe in the risk-free return. Bernie Madoff died in prison in 2021, but the ghost of the 17th floor is still haunting the markets. Today, private credit markets and private equity valuations are opaque. Billions of dollars are managed in structures that do not mark to market daily. We accept valuations because a manager says so. We are repeating the same behaviours. The next Madoff won't be a guy in a suit in the lipstick building. It will be a smart contract or an AI-driven fund that claims to have solved the market. And when you ask how it works, they will tell you it's too complicated to explain. They will tell you it's proprietary. And if you are lucky, they will let you invest. When you hear that, I want you to remember Harry Markopolos. I want you to remember the dot matrix printers fabricating trades. I want you to remember that if the math doesn't work, no amount of reputation can save you. United Fruit didn't disappear, they became Chiquita. The Ponzi scheme didn't die with Madoff, it just changed its medium. Make sure you are subscribed to Capital Curriculum so you can spot the next one before it takes your capital. The market is a crime scene waiting to happen. Don't be the victim.